Thanks a lot, Jackie, and thanks for having me. So my name is Johnny. Now I'm a bit unusual within the RBA because on Monday to Wednesday I work in our economic analysis department. I'm the head of our national accounts and forecasting section. But then on Thursday and Friday I work in a different department, our economic research department, where I do sort of longer term research and produce working papers that go up on the RBA website. And I work a lot with big data, and I work a lot on topics like inequality and housing and the transmission mechanism of monetary policy. So that's basically why I'm here to talk to you today. But on a deeper level, the reason why I'm here to talk to you today is because of this man. I think you've got this in your chart pack. This is Mr. Roger, Mr. Keith Roger, my economics high school teacher. I was at Borker Mills High in the 90s. And he inspired me to go on and do economics at university. He inspired me to go on and do a PhD in economics, and he inspired me to work at the RBA. So I want to especially thank him for what he did for me, and indirectly I want to thank you all too, because the fact that you're actually here for your students shows how much you care for them, and I'm sure you're inspiring many of your students like me as well. So thanks to Mr. Roger, and thanks to you. So here's a picture of some charismatic, pensive-looking guy at the front of the RBA who was accidentally caught on camera when Channel 7 had their cameras pointed at the RBA. Now, apparently I'm now part of stock footage. So when newspapers use pictures of the RBA, I show up in that, which is nice to be remembered. Now, I would like to think that as I am standing there at the front of the bank, leaning at the front of the bank, that I am grappling with questions like, how does monetary policy work? How do interest rates affect the economy? What are the channels? But I was actually trying to work out where to go for coffee. But these are questions that I do often grapple with. So in terms of an overview of what I'm going to talk about today, I'm going to very quickly talk about the three stages of the monetary transmission mechanism. I'm then going to spend most of my time talking about the different channels of transmission. And the way I'm going to do that is I'm going to go through how those channels are described in textbooks, in school and in university textbooks. But I also want to just give you a little bit of evidence, or empirical evidence for each of these channels and what we kind of know, what's the current thinking on how important each of these channels are. I thought that would be kind of sort of new and potentially interesting for you. I'm then going to spend just a little bit of time at the end talking about which channels we often think of as being most important and how they might have changed over the course of time. And then I'll sum up by talking about, if you bring all these channels together, what do we find as the overall effective interest rates on the economy? So in terms of the stages, so we can sort of think about it as three separate stages, and that's each stage is shown by these kind of arrows. So the first stage, which I'm not going to talk about a lot today, but my colleague Catherine will talk a little bit more about it in the next session, that's the link from when we change the cash rate to going on to change other interest rates in the economy. So the deposit rates, the lending rates faced by households and businesses. That's not to say that that's not important to the transmission mechanism. It is. And we talk a little bit about that there's a monetary policy transmission mechanism explainer that I think is part of your chart pack and will be on the RBA website too. So we talk a little bit about that. It's an important stage, but I think perhaps the more interesting stage for me anyway is stage two, going from interest rates faced by households and businesses to economic activity, to spending and saving and investment decisions. The third stage you can think of as the stage from going from economic activity to inflation. Now, for pretty much all the channels I'm going to talk about today, that link is pretty much the same. So the idea is basically we reduce interest rates through a bunch of different channels. That increases economic activity, and then that goes on to increase prices for firms that can't actually produce enough stuff to satisfy demand. So, but the channels pretty much all work the same way for that third stage, so I'm just going to focus on stage two. And this schematic, this diagram appears again in this monetary policy explainer, and it basically summarises all the channels of transmission as we think about them. But don't get freaked out by the amount of detail on it. I'm going to go through it one channel at a time. And the first channel I'm going to talk about is what we call the saving and investment channel. So this is the link from cash rate to other interest rates to household spending and investment, and then on to inflation. So who remembers Dolomite Accounts? How did Dolomite Account? Apparently they still exist, so I obviously Googled this, excited to find pictures of Dolomite Accounts as I remember them in the 80s. There were these weird little alien creatures in the top left. It turns out they've been rejigged a little bit today, and they sort of, I don't know, kind of Pokemon, funky, edgy characters in the bottom left corner. So I'm going to explain this whole channel through the use of Dolomite accounts. How does this work? All right, so in theory, so we reduce the cash rate, that reduces deposit rates that households and businesses face, and that gives them less incentive to save and more incentive to spend. And that also works through reducing borrowing rates. That encourages people to borrow more and spend more. So it's a fairly intuitive and relatively simple channel. Economists like to call it the intertemporal substitution channel. Sometimes more boringly, it's just called the interest rate channel. It is generally the channel that they focus on the most in macroeconomic models. So even models today use this particular channel as the main driving force for how monetary policy affects the economy. And in theory, it works through these Dolomite accounts for households. It also works for businesses. They've obviously got deposit and lending accounts as well. But what's interesting is even though it's the key kind of channel, in practice, it's super hard to actually find good evidence for this particular channel. So there's an ongoing debate across central banks within the RBA on whether investment, business investment, is actually sensitive to changes in interest rates. When we cut interest rates, do businesses actually invest more? So when we go out and ask them on our liaison program, often they say no. If we reduce interest rates, they're not going to actually spend any more or invest any more. But I can give you a little teaser for some work that I'm doing with a colleague in our research department. So we've gone and hand-collected information that all the businesses, when they do investment at a business level, we can see their investment, we can see the interest rates that they're paying on their loans. And what we find when we look at those kind of data, this is new, hand-collected, unique data, we actually find there is actually some correlation. When interest rates fall, it looks like businesses actually invest more despite what they say. And that's partly because we talk to a lot of large businesses, but this data set has a lot of small businesses in it. So I think there's a distinction here between small and large businesses that's important. Now, it's also surprisingly hard to work out if households are actually sensitive to interest rates through this particular channel. And that's because the data that you actually need to do this is quite hard to get. You need to be able to observe everyone's Dolomite accounts, look at what happens before and after an interest rate change, what happens to their spending. You just basically don't ever get that kind of data. Now that doesn't stop people from looking at this particular channel, and what this map of the world is designed to represent is all the studies that have been done on this particular channel. So there's been 200, 300 studies using a range of techniques to look at how important this channel is. And don't worry, you probably can't read the legend, it's not important. If you're interested, I can give you the reference to this paper. It's by two Czech economists, and they've gone to all the trouble of collecting all this information from all these different papers to see what people say about this particular channel. And what they've found is that, at least for Australia, you can see in the sort of light blue here, is that it suggests that there is some evidence that this channel actually matters in Australia. They find some evidence for it. Curiously, New Zealand looks like it's slightly stronger. No idea why. I think it's just differences in the way that they've measured these things. But I thought that was kind of interesting, that there is some evidence for this particular channel. Now, I'm going to talk quite a bit about my favourite channel. It's the cash flow channel. It's my favourite because I've done work on it, so I'm very biased. Let me take you through that. Now, and I've also gone to a lot of trouble to go and hand collect all these newspaper headlines, pictures of people with mortgages. If you Google in images, families with mortgages, you'll be surprised to learn how many pictures you get of happy-looking people sitting around in empty houses with boxes around them, or people jumping up and down in front of houses. But anyway, this I think is an interesting channel because this is all about like the winners and losers of when there's an interest rate change, a cut or an increase. So you'll often see headlines when we're cutting interest rates that the borrowers are winning, the people with mortgages are kind of winning. We're giving them more income when we cut interest rates. On the other hand, I know at least with our previous governor, he used to get a lot of letters of complaint when we cut interest rates, and letters of complaint from self-funded retirees saying you're reducing the income I'm earning on my bank deposits, and that's going to hurt my spending. And so you'll often see headlines like this: whenever we reduce interest rates, things are looking bleak for retirees. All right, so the borrowers are kind of happy when we're cutting interest rates, the savers not so much, and obviously vice versa when we're raising interest rates. And I should say a lot of what I'm going to talk about today, I'm going to talk about in terms of cutting interest rates, given that's what we're doing at the moment and have been recently, but it also applies to increases in interest rates, all these channels. So how does this cash rate channel work? So I think it's useful to actually think of it as two separate channels. One is what I'm going to call the borrower cash flow channel, and one is the lender cash flow channel, the saver cash flow channel. The borrowers are the people with the mortgages, the lenders are the self-funded retirees. You can loosely think of them that way. And so this is the idea that when we cut the cash rate, it reduces mortgage rates for borrowers. That reduces their mortgage repayments. That gives them more disposable income, more cash flow, and they might decide to go out and spend that. Particularly the people that are kind of cash constrained or liquidity constrained, they're likely to spend that extra money. But on the flip side, when we cut the cash rate, it reduces the deposit rates for the retirees. It reduces their interest income, and potentially it reduces their spending as well. And so it's kind of a question of, okay, which of these channels, they work in opposite directions, which channel dominates, which is more important? So me and a couple of colleagues went and wrote a paper on this. We actually got data on all these different people and had a look at who's most sensitive to interest rates. And what we find is that the borrower channel clearly dominates the lender channel. These two channels actually they do operate, so when the retirees complain, there is some evidence for it in the data. They do cut their spending when interest rates go down, but the effect on the borrowers far dominates. Now, interestingly, when you crunch the numbers, these two groups make up similar shares of the population, so they're two similar sized groups. What's different about them, though, is that the borrowers hold a lot more debt, a lot more mortgage debt, than the lenders hold in deposits. So the average amount of debt, the average mortgage, is much bigger than the average bank deposit. So that means that when we change interest rates, the effect on their income or their interest payments is much stronger than the effect on their interest income. So that's one reason why the borrower channel is stronger. The second reason is a bit more subtle. The second reason you need statistical analysis to identify, and the second reason is that for a given change in income, when we cut interest rates and we give the borrowers more income, they're much more likely to spend it than when we cut interest rates and cut the income of the lenders. They don't reduce their spending by as much. So we talk about this in terms of the marginal propensity to consume. It is much higher for borrowers than it is for lenders. And that kind of makes sense. Like the fact that they are borrowers means that they really want to spend. So you give them a little bit of extra income, they're more likely to spend it. Am I allowed to take questions as we go?
I think it's helpful to manage time to have them at the end.
Okay, sorry, sorry. So yeah, two reasons why the borrower channel is stronger. It's differences in their sensitivity to income and differences in the size of their debts and their deposits. And there is also some evidence, and we're doing this internally at the moment, looking at businesses as well. So I just talked about households, but there's some evidence that there's a cash flow channel for businesses as well. I call it an exciting area of research because I'm involved in it. But it is actually an interesting and growing area. We're getting better and better data for Australia, for overseas, to look at this channel. So it's quite an intuitive, quite an obvious, simple channel, but there hasn't been any work done on it anywhere in the world until the last couple of years. The third channel is the asset price or wealth channel. So this is the idea that when we cut interest rates, cut the cash rate, that reduces lending rates, borrowing rates for people with mortgages. That pushes up the demand for housing. That pushes up house prices. As house prices go up, people get wealthier. They decide to spend more because they're wealthier. So I've just described that in terms of housing. You can also describe it in terms of financial wealth. So when we cut interest rates, it tends to push up share prices. Financial wealth goes up. They tend to also spend more as a result of that. So this is the wealth channel. Now what's interesting is that I described it in terms of housing because the evidence that we have for it seems to be stronger on the housing side. And I think Michael Plum, in his previous presentation, talked about housing being the most interest-sensitive sector of the economy. That comes across quite clearly in this line of work too. That it looks like house prices are more sensitive to interest rates than, say, the share market or other types of financial assets. Also, there is good evidence that when house prices go up, people tend to spend more. But what's interesting is that we don't know necessarily why that's the case. So there's a whole bunch of theories. You probably have theories on why when house prices are high, people spend more. Some of my colleagues looked at this in a paper a few years ago. It was published on the RBA website. They went through all the reasons why it might be important. One of the things I find really interesting when you look at this particular channel is the distinction between homeowners and renters. So when I described this channel, house prices go up, you get wealthier, you spend more. That, I'm implicitly assuming you're a homeowner, right? So if you're a renter, as house prices go up, you're not actually better off, you're probably worse off, right? It's harder for you to buy a house, your rent is probably going up, it's actually going to potentially make you spend less because house prices are going up. But what they find when we look at the data is that both renters and owners respond positively to an increase in house prices. So when house prices go up in your local area, as a renter, you tend to spend more on stuff, not just rent, but other stuff. And that's kind of interesting. That suggests that house prices are kind of capturing some sort of vibe in the economy, like overall sentiment in the economy that everyone's positively responding to. There is also an ongoing, it's a bit of an academic debate on whether housing wealth is really wealth. So this is kind of the idea is, again, if you're a homeowner, as your house price is going up, it's not usually going up in isolation. Everyone else's house price is going up too. So you're not necessarily any better off when your house price goes up. You're not necessarily any wealthier, because what are you going to do with that money? You might trade up. You're usually going to trade up. You're going to buy an even more expensive house. So you never really realise that money until you're older, maybe when you're trading down. But even then, a lot of people have bequest motives. They want to leave their money for kids, so they never actually get to see the money. So actually, there's a whole debate on whether this increase in house prices should actually affect spending. But in practice, we find it does. We also find evidence that increases in house prices push up dwelling investment in housing. So property developers look at what's happened to house prices and they go, oh, I can get more money, and therefore they build more homes. So we also see that in the data. Finally, we have the exchange rate channel. And I've split this up into two kind of channels. There's sort of a direct channel and an indirect channel. When we cut interest rates at home in Australia, so the way to think about this is we reduce interest rates relative to the rest of the world. So if you're an investor, either in Australia or overseas, you're going to get a better return by parking your money overseas than here when we cut interest rates. So what that tends to do is lower the Aussie dollar, lowers the exchange rate, the relative price of our stuff compared to the rest of the world. As the exchange rate falls, what you see here is an increase in the volume of exports and a decrease in the volume of imports. So other people's stuff becomes more expensive, we reduce our imports, and our stuff becomes cheaper, increase our exports. But the other, I would call this a more direct channel, is just as exchange rate falls and other stuff becomes, overseas stuff becomes more expensive, import prices go up, and it feeds directly through to our consumer price index, because a large chunk of the consumer price index is made up of imported stuff, whether it's cars, clothing, computers, whatever. It has a very direct effect on inflation in Australia. Now, there is some evidence, this is a little bit controversial, some evidence that interest rates affect trade, that affect exports and imports. So we've done work to show that when we change the cash rate, it has some effect on the exchange rate, at least in the very short run. So we're talking hours, days, weeks, maybe a month. This is a paper from a research discussion paper from 2005. If you're interested, I can give you all the references to all the stuff I'm showing. By Kearns and Manners. And what they're showing here in this graph is the hours before and after an interest rate change. So come first Tuesday of the month at 2:30, we're going to move the cash rate potentially, and they've looked at a whole history of this data. And what you see, if you look at this very timely data, is that at least when you increase the cash rate by about 100 basis points, the Aussie dollar jumps by about 0.5%. And that's not a particularly strong effect. And it occurs within an hour. It persists for a few days, up to a month in this paper. So it's not actually a particularly strong effect. We don't typically increase or decrease interest rates by 100. So it's not a massively strong effect. And then also, it can be hard to find an effect of the exchange rate on total exports or total imports. That's partly because a lot of our exports are sort of mining, resource-related exports that don't depend so much on the Aussie dollar, but depend on demand from overseas. Things like services exports, tourism and stuff tends to be more sensitive. But this particular channel is not as strong as the more direct channel through impacting on prices, impacting on import prices and impacting on inflation. There's a lot more evidence for that. So what does this all mean? If we bring all the channels together into one and we look at our models of when we change interest rates, what happens to GDP, what happens to inflation, this is a summary of what we see in these models. So what we find is that if you hypothetically reduce the cash rate by 100 basis points, you'll see GDP, the light blue line here, will jump up over the course of, this is numbers of quarters along here. Within about a year, it's jumped up by about, you can see about 0.6%, and then it gradually kind of declines here. So there's a lot of uncertainty around these estimates. It kind of depends on the model that you run and depends on the time period that you look at. But what you generally find is the GDP goes up by about 0.5 to 0.75% over the course of about 2 years for a 100 basis point cut to cash rate. Inflation increases by a bit, about 0.25% over the course of 2 to 3 years. So some things that I'm currently grappling with and others are grappling with. Which of these channels matters the most? I've given hints of which ones I think matter the most, but it is actually very hard to say because there's no way of kind of comparing them all at one time. It depends on the state of the economy, it depends on a whole range of factors that we're going to talk about in some research coming out in the near future. But I think the fact that it's easy to identify some channels and not others, because lots of people have looked at these things, both in Australia and overseas, the fact that it's actually easier to find some, like the cash flow channel kind of stuff, suggests to me that maybe those channels are more important. That's just putting it out there. Have they changed over time? Again, very hard to say. The evidence, when we've looked at this, when we've run these models over different periods, we don't actually find a lot of evidence that, say, monetary policy is less effective today than it was 5, 10 years ago. We don't find much evidence that's stronger. In the cash flow channel research that I've done, I do talk a little bit about that particular channel and whether it's any stronger or weaker today. But overall, we do still find clear evidence that monetary policy has an effect on the economy. And which is my favourite channel? That's easy. That's the cash flow channel, as I told you earlier. It's also, I like to think, our former governor's favourite channel. So in his exit interview with the Australian Financial Review, they actually asked him, how would you judge the transmission mechanism works here now? And it's a fairly long quote, but if you don't mind, I'll read it out. Glenn Stevens said, I would say that cash flow channels still probably work. Maybe not as strongly as they used to, because I think the evidence is that borrower households, that's where the action comes from. And the way this is supposed to work is that borrowers have more debt than the savers have deposits. It's because I told him that. That's a fact. And when you change rates, the borrowers are the ones who are spending all the income. Again, as I said, they're more sensitive to income. And if I give them a bit more income, they're likely to spend that. And the savers, the cut to their direct income is actually not as big, and they're less likely to respond. So the same two reasons I said before. A little bit biased because he did read the paper that I wrote beforehand, but he did seem to think the cash flow channel was important. So in conclusion, there are quite a few channels through which monetary policy affects the economy. I've taken you through 4 broad channels today. It can be very hard to separate these things, and therefore it's very hard to say which is sort of more stronger than the other. But I find it informative that you can find evidence more for some than others when you keep trying to find these channels. And a little teaser for some work that my colleague Tim Akin and I are doing that will be available in September is going to be going through what I've just talked about today and in a little bit more detail as well on some of these channels and what we know about them in practice. And that is it for me. Thank you.